And we are back with our friend, financial consultant and chartered financial analyst, John Rhodes. He manages the Charles Schwab branch here in Augusta, and he joins us this morning breaking down the stock market and seeing what things are looking like at this time of year. And John, there's been a lot of activity as of late.
Oh, yeah. It's been a very exciting month since last time I was on your show.
Exactly. So how are the markets looking since we last saw you?
Well, amazingly, we had a lot of concern where we would open yesterday morning, given the news over the weekend. And the market opened up, then faded into the day, and then closed up quite strongly, over 300 points yesterday afternoon. And today, this morning, futures are up on the open. I guess we're opening right now, so I don't know exactly where we are, but the indicators were for a positive opening.
Something we've said over the last number of months too. It's up, it's down, it's back and forth. So we're going to be seeing that a lot. Right.
And it's what we constantly are reminding our investors. Successful investing is not about the short-term volatility. The markets are going to be volatile. What you have to do, though, is put together a game plan, have some long-term objectives, and then get positioned to achieve those objectives. And I tell people all the time, successful investing is a marathon. It's not a sprint.
Right.
Can you tell us about some of the announcements from the Federal Reserve?
Sure.
Yeah.
The Federal Reserve has, I believe it's 9 meetings a year. Last week, they held their press conference for the month of June, stated that they saw no reason to reduce interest rates, that the economy is quite strong, although some of the leading indicators are suggesting that our GDP will probably be a bit lower this year.
Right.
Okay.
Some of that was, as we discussed last month, or perhaps it was the month before, the rush to import. And imports actually are a detractor from GDP. But interestingly enough, once those imported goods are in the States, they're a positive contributor to GDP. So, we will have some positive economic readings through the year, but it's not going to be one of these 3-4% growth years. It's probably going to be a 2 to 3% growth year.
Okay, so with all of this kind of back and forth and a little bit of uncertainty, how should investors position themselves for this?
For the long term.
Right.
The main thing is to be aware of what the returns are in the different asset classes. Before we went on, you asked about gold, Mary, and so, commodities have their own return characteristics. Stocks or ownership of cash flow producing, profits producing businesses have their own return characteristics. Bonds or money market instruments where you're a lender have a lower set of return characteristics. And so mixing those together and coming up with the right mix that fits your comfort zone, your risk acceptance, tolerance, is what successful investing is all about. And again, it's staying focused on the long term. The U.S. economy is the largest economy in the world and will continue to be for quite some time. It will continue to grow because our consumers are constantly spending, consuming. As long as that continues, stock prices will go up over the long term.
So, okay, so to close in on this, what you're saying is don't do a knee-jerk reaction and pull back.
Right.
If you think things are looking a little odd.
Right. I've got a number of calls over the weekend that, what should we do if missiles start flying? And little did we know what would happen over the weekend. But many people were expecting me to say, well, we'd have to get more conservative. It's actually the opposite. And there's an old Wall Street saying, when the missiles fly, it's time to buy.
Wow. Who knew?
You heard it here.
Well, say somebody who doesn't really know too much about the stock market, it can be a little bit intimidating. Where can they go to get somebody to help them? Well,
that's what we do day in, day out. There's no cost for what we do. We're there to advise folks on how to accomplish their investment objectives. We're not compensated by what they invest in. We merely coach folks on how to be successful long-term investors. Last month we talked about index funds.
Right.
That's absolutely the best way for your typical novice investor to get involved in the stock market is just buying an index fund. They trade for as little as $25 a share. And so it's very easy to get involved with a modest amount of money, begin monitoring the market and gaining confidence that you understand how it works over time.
Baby steps. Yeah. You can take it down here as well. And yes, no more knee-jerk reactions. Things are going to be okay with this. John Rhodes, always good to talk to you. Thank you so much, sir.
Thank you, Cliff.
Appreciate it.